Would you trust a strategy that is so simple it looks like a joke? Well, billion-dollar hedge funds do trust these simple strategies. Now, you might have heard of CTA strategies or trend-following strategies, and those are the simple strategies that are traded with billions of dollars. So if you are a trader or an investor who thinks you need complex strategies, then you need to think again. And I hope that this video will open your eyes to more simpler approaches. There are so many trend following strategies, but the most popular one is the 40-20, which is 40 to get in and 20 to get out. This strategy mainly was popularized by the turtles, where a professional trader took people who knows nothing about trading and he taught them this strategy and made hundreds of millions with them. And in this video, I will show you the construction of this strategy, how it works, long and short, and what are the tricks that hedge funds use to update this strategy in today's market. This is the strategy in its simplest form. We have two lines on this chart. The red line is tracking the highest high of the past 40 bars, and the green line is tracking the lowest low of the last 20 bars. And so the strategy dictates when the close is above the 40-day high, we buy, and when the close go below the 20-day low, then we sell. And it's the opposite for shorts. So when the close is lower than the lowest low of the past 40 bars, we go short, and when the close is above the highest high of the last 20 bars, we exit. Now, the strategy is so popular and many books have written on it, so ChatGPT knows everything about it. And here is an example. I just asked it, how does the trend following strategy 40 in, 20 out works? And this is the response. There is no training on this ChatGPT. It's ChatGPT 4.0. So here are the entry rule: 40-day high breakout, go long when the price closes above the highest high of the past 40 days. This signals a potential uptrend and the trend assumes momentum will continue, which is true for the past almost, I think, 1,000 years. That momentum will persist because there are studies that have been done, I think, since 1100. On the price of rice and wheat and how momentum persists usually. The exit rule is when the close is below the lowest low of the past 20 trading days. And short is the opposite. And here are some key points: no prediction, it's purely reactive to price action. So you don't need to look at fundamentals, news, anything. It's basically a price reaction. Simple but effective and works well on most markets. So here is the strategy implemented on the S&P 500 futures daily bar. And if we look at the test since 2006, 40 in, 20 out, we have 41 trades on the long side. Average trade is 13.95. And this is the periodical analysis, but you see very few trades. And here is the performance of the short side: 33 trades, losing on average $1,300. And of course, we know this already, that the S&P 500 tends to do very well with long mean reversion strategies. So it's still doing well long momentum, but on the short side, it doesn't work. In fact, if you optimize all the values, nothing will work. All the short strategies, trend following, are losing on the S&P 500 using this methodology. But in terms of the number of trades, we can easily increase that by going to a lower time frame. So here is the same futures, and now we are doing 720 minutes. So that's 12 hours, and still with the same rules, we get 97 trades instead of 41. So we almost double the number of trades, and we still are getting a very good average trade. And this is the annual period analysis, and we see now we have better trades. So this is the same market, same strategy rules, but now we are doing it on 360 minutes, which is 6 hours. And now we again double the number of trades to 184, but our average trade suffers a lot. So between 6 hours and 24 hours, the 12 hours time frame seems to be the best compromise. Now for hedge funds, of course, they have lots and lots of money, so they cannot trade a single market. There is not enough volume in any market to sink hundreds of billions in it. So they have to trade multiple markets. So here is the same strategy, 40 in, 20 out, and the short side, again, 40 in, 20 out. And this strategy now is applied to all these futures markets. So I didn't optimize anything. It's still the same rules. And as you can see, not all markets love this strategy. But if you dig deeper, you will find it's not they don't love the strategy, but sometimes, for example, this is British pound. You see the long side is losing, but the short side is making a good win. Also, even though this mark is profitable, this is the ES, you will notice, of course, that the long side is winning and the short side is a huge loss. Gold, again, the same story. On the long side, we're making huge profits, huge average trade. But on the short side, we are losing huge, even though we are making same amount of trades. Now, remember, all these are daily time frame. So the idea is you need to figure out the markets with the highest tendencies, like the S&P 500, and just skip the short side on these markets. And some markets like natural gas, you should skip the long side of those markets. For example, this is natural gas, and you see on the short side, we are making $3,000. On the long side, we are losing on average $700. Now that applies to the highly biased markets like the S&P 500 and natural gas on the daily time frame. The other markets, so for example, let's take coffee, which is a market that is known not to do well in trend following, but it is not biased in any direction. And recently it did very, very well. So these markets, you should keep them in your portfolio, even if they are not performing well, because you never know when the next trend will happen. Now remember, this strategy was developed long time ago, and we can easily enhance it. And in fact, ChatGPT also knows this. So here is my next question to GPT, which is what other rules that enhance this strategy? And it suggested several. Volatility filter, moving average filter, which is direction, which is what I always advise, volatility and direction. And then we have position sizing based on volatility. That will also enhance performance. Risk management enhancement to correlated markets. And adding a time-based exit. So if you don't make money within 10 bars, 20 bars, you should exit. Trailing stop. Volume filter. Avoid entries before major events. Multiple breakout levels. And use in a portfolio. Now I have many videos on the channel using filters, so I thought we should use something new in this video. So I will focus on point 9 and point 10. So point 9 is multiple breakout levels. So this is our strategy on the long side on the S&P 500. Let's optimize this strategy. So this is long and short. We are long, and we will not use the short side. So we're only doing the long side. So we will do 5 to 100 instead of 5 for both channels. In total, 400 combinations. And if I sort by return to drawdown, on the top we have 35 and 15, and then 40, 15, 30, 15, 55, 15, and then 45, 15, and 5 and 15. So a lot of 15s showing up at the top. And of course, we have other values, 20, which is very close to 15, another 20. So let's fix 15 and run the optimization again. So this time we will fix the exit at 15 and we will optimize the entry from 5 to 100. So in total, 20 combination. Here is a 2D graph of the net profit, which is the green line, and the return to drawdown, which is the purple line. So this is net profit, and this is the value of the breakout to get in. And this is the trick that hedge funds use to deploy high capital, because they have hundreds of millions. They cannot just simply go in and buy 50,000 contracts. They have to do it on several bars. And this could take probably 2 weeks to get in and 2 weeks to get out. And the way they do it still systematically, and I'll show you how they do that. And you as a retail trader also can follow the same procedure. So here is what they do. Instead of deploying all money in one system, for example, here we can take 10 systems. So 5 and 15, 10 and 15, 15 and 15, all the way to 50 and 15. So these will be 10 systems. Now, as a retail trader, you can gain 2 advantages by following this procedure. First of all, you can, instead of trading one mini contract of the S&P 500, you can trade 10 micro contracts of the S&P 500. Theoretically, you will need same amount of money, but you will increase the robustness of your system because you don't know in the future which one of these will happen. So 20 and 15 could be here, and 35 and 15 could be here. So you're averaging out all these values using the same strategy. And here is what it looks like. So here I have 10 strategies trading the ES daily time frame. And you see here I put 5, 15, 10, and 15. So I'm trading the same exit, but different breakouts from 5 to 50. So those are 10 strategies trading the same exit, but different entries. And this is the return of all of them. Remember, this is the daily time frame. And of course, all of them are making money. But like I mentioned, now you are averaging the 10 as a single strategy. Now, of course, these strategies will be highly correlated. So based on weekly, you can see that it is highly correlated. It's much better to trade this than a single strategy. When I first started my journey into trading, I thought these are silly strategies and there is no way that you can make money with them, especially when you trade a single look back period on a single market. So I skipped them all together. It's only when I learned about Dun Capital and Winton Capital and how they trade billions of dollars with these strategies, it then clicked, and then I started developing my own momentum strategies. And now I have multiple momentum strategies that I trade as a different bucket from my algo trading strategy. You can find them on my website, StatOasis.com/TAA portfolios. If you like this video, then you will love the next one.